bunched around a mean or average. In option trading, this may be defined as how tightly stock or index prices are bunched around the current price. The standard deviation is based mainly on an estimate of future stock or index volatility, a future date, and the current stock or index price. The higher the volatility, the bigger the standard deviation. The farther the future date is, the bigger the standard deviation. The larger the stock price, the bigger the standard deviation. So we all know this bell curve, right? So here we can see one standard deviation. What for we use this? We use this when we want to look for shorting option, right? Shorting option means out of money call short and out of money put short. That we call as short triangle. So if you want to short option, if you short, and this is at the money strike, right? In the center is at the money strike. If you short one standard deviation OTM call and one standard deviation OTM put, then chances of making profit, that means the expiry will be within that range, are 68%. Right, 68%. If we go for two standard deviation, it's almost 95 to 97%. And if we go three standard deviation away for shorting the option, then it's almost 99%. Right, three standard deviation is almost 99%. Got it? So what is current ATM? We have seen 17,350. Right, so where to check for the standard deviation? There are formulas, but we need not go into the formulas. There is a website called as stocksonfire.in. Right, so if you go to this website, or even if you put in the Google stocks on fire standard deviation, this is the formula. One standard deviation equal to stock price into volatility into square root of days to expire. But we need not calculate it. If I click on this, right, it will open this website stocksonfire.in, and here is written standard deviation calculator for Nifty, Bank Nifty. It's a screenshot. Below here you can read, click to view today's standard deviation level. So you have to click on this. It will open the new page. Right, so it is for all the stock. One standard deviation on the downside and one standard deviation on the upside. So upside standard deviation we will be using for looking for call strikes, which we want to short if someone wants to follow this method. And downside for standard deviation we will be looking for put strike. So if we scroll down, we will be getting for Nifty. Right, so Nifty is currently at 17,350. Minus one standard deviation is 17,155. Right, so approximately we can say 214 will be one standard deviation. Right, so 17,350 minus 214 will give us one standard deviation. If we subtract from this, then we will be getting two standard deviation. If you want three standard deviation, so exact level of Nifty is 17,369. Right, 17,369 minus 17,155. So it's 214. Okay. So for Nifty, we have got 155, so 214. So 17,155 minus 214, we will be getting 16,941, right? And if we subtract 214 from that, it will be 16,727. 16,727 will be three standard deviation on the downside, and on the upside it will be similar. 17,369 plus 214 will give us 17,583. Again, if we add, that will be 1 standard deviation. 2 standard deviation is 17,797, right? For 3 standard deviation, again add 214. So that is 18,011. So if we short 18,000 call and 16,700 put, the chances that we will be getting, so what is the premium for those strikes? $18,000 is 2 rupees 70 paisa, and 16,700 is put is 7 rupees 50 paisa. So roughly 10 points, right? Lot size is 50. So 500 rupees, chances of making 500 rupees profit are very high. Almost 99% you will be getting this profit if you short this price. If we short 2 standard deviation, what were the 2 standard deviation levels? 2 standard deviation levels, 16,900 and 17,800. So if I short 16,900 and 17,800, 17,800 is at 5.35 and 16,900 is at 12 rupees. So 12 plus 5, that is 17 points, right? 17 points. So 17 points multiplied by 50, so almost 950 rupees. You can make, chances of making those 95 rupees is 95 to 97%, because we are shorting 2 standard deviation. This is one method which many traders use. Okay. So any confusion in this standard deviation? Yes, for stocks also it will be changing. So you will be getting it for all the stocks here. So if you see Reliance, 1 standard deviation is 23. 23.30 is 2 standard deviation, and 25.21 is 2 standard deviation on the upside. So if I go and check, Reliance, but that's a monthly, right? 30th September. So better you go 3 standard deviation away. But we will just check what will the strike prices, 23.30 and 25.20. So 25.20 is trading at 31 rupees, right? And 23.30. 23.30. So 23.30 is trading at, it's 23.20 is trading at 18. So if we take 23.40, it's trading at 22. So 22, if you short 23.40 put, and if you short 25.40 call, so 26 plus 22, that is 48 to 50 points, right? So 250 into 50, that will be around, I think, 12,000 something, right? So that much profit you can make. Probability of making that much profit is up to 95%, 95 to 97%, because you are selling 2 standard deviation strike away. So if we have a supply zone around highest OI with 2 standard deviation or 3 standard deviation matching near that, and we have a demand zone, right, near the highest put with 2 standard deviation or 3 standard deviation matching with it, then we can think of initiating this short triangle, because it will keep on moving between the supply and demand zone, as well as highest OI, as well as standard deviation, right? So we will be making profit in such cases. Yeah, it's 12,500. Margin required, we can check on Opstra. Here in options, you go to the options, go to strategy builder, right? So if you want to check for Reliance, you type Reliance, select it, we are trading options. Expiry is 30th September 2540 CE. We are looking for sell, that is short, add this position. Then 2340 put, we want to sell, add this position. So both these positions are added here, right? So max profit is 12,212 and margin required is 1,30,000, right? 1,30,000. So around we can say 10% returns we can expect. 95% probability that we will be getting 10% return. So around on 1,30,000 we will be getting around 12,000 profit. So this is called as payoff chart, right? So you can see if it expires between 2340 to 2540, you can see the profit is 12,200, it's constant, and your break even is 2290, right? This line is for loss. The red color shows loss, green color shows profit. So if it goes below 2390, you will start on the expiry day, you will start making losses. Or if it goes above 2580, right? 2580, then you will on the expiry day, it remains above this, then you will start making the losses. But till it remains, so this range is almost how much? 2280 to 2580, so 300 points. So roughly we can say 10%, 10 plus percent range is there for how many days are remaining? Maybe 2 weeks working days if we consider, right? 2 weeks if Reliance remains in this range, then we can get 9.4% return, right? So on Opstra you can do all the permutation and combination and check for all the stocks and indices, whichever you want. Clear? See, the margin required is 1,30,000. So at any given point of time, this much money should be available for initiating this call and put, right? It should be available. But don't go and jump and short Reliance call and put, right? We have to follow the roadmap given and then you have to look for these things. At present, don't jump for this. So if it goes down, then you have to maintain this much margin in your account for shorting call and put of Reliance. Okay. So that was about important aspects of